U.S. equities have staged a remarkable rally in the first half of this year. But is the bull market still on firm footing? And how optimistic should investors be now?
If I think about the series of earnings reports that we'll get in the second half of this year, there'll be a lot of focus on what is the potential revenue gains and earnings contributions coming from all this investment that's being made in AI. There's a lot of questions around that.
I'm Allison Nathan, and this is Goldman Sachs Exchanges. Today, I'm sitting down with my colleague in Goldman Sachs Research, David Kostin, Chief U.S. Equity Strategist. David recently boosted his S&P 500 year-end target from 5,200 up to 5,600. We'll talk about what's changed, what investors should focus on now, and what the rest of the year could bring. David, it is great to have you back on the program.
Allison, thanks for inviting me.
David, when you made your recent upgrade, you made the very interesting observation that 5 stocks have been responsible for 60% of the rally year to date. There's so much focus on market concentration today. Is that concentration concerning to you at all?
I think the best way to frame the return for the U.S. equity market this year is to keep 2 numbers in mind. The first is that the S&P 500 index, which is a capitalization-weighted index, has risen by 15% year to date. In comparison, the typical stock has risen 5%. And that difference is really a reflection of the point you made that 5 leading stocks, mostly associated with artificial intelligence, they have driven the market capitalization index up 15%. So those companies include NVIDIA, Amazon, Microsoft, Google, also known as Alphabet, and Meta. They're the companies that are making significant investments in their CapEx and R&D. That is totaling now around 22% of all CapEx and R&D dollars, research and development dollars spent in the country, are by these companies in pursuit of the AI dream.
And these 5 companies are driving the market performance.
That's correct. Now, the fundamentals actually support this. Those 5 companies have increased their earnings in the first quarter by 84% versus the prior year. In comparison, the rest of the market had about 5% increase in earnings. And so fundamentally, it has been better earnings have helped drive these share prices higher. That's the actual results for the first quarter. If we think about the earnings revisions that analysts have made for these companies as well, they've increased their estimates by 38% in comparison with a 5% reduction in earnings estimates for the rest of the market. And so fundamentally, it's been better earnings, better expected earnings, which have lifted these stocks and therefore had the whole index level rise about 15% this year.
So it's not hype, it's real fundamentals. But I have to ask then about really one of the key drivers, which has been NVIDIA off of the AI theme. And very recently, we've seen some underperformance in that stock. I'm not asking you to talk about the stock, but does that make you nervous, though, even if it is real performance leading to real returns, that these stocks can be vulnerable and have a big impact on the market?
It's an enormous question, and there's been a swift pivot that's taken place in the last several weeks from portfolio managers. Portfolio managers had been really embracing the euphoria, the excitement about AI and what that might mean for corporate profitability, for business activity, productivity in the economy. And more recently, that has shifted, and there's much more questioning of managements whether or not they can actually deliver better financial results as a consequence of all this investment that's taking place. I think there's a serious issues that need to be addressed, and that will probably come to fore in the next 6 to 12 months. If I think about the series of earnings reports that we'll get in the second half of this year for the second quarter results and the third and the fourth quarter for early part of next year when those results are released, there'll be a lot of focus on what is the potential revenue gains and earnings contributions coming from all this investment that's being made in AI. There's a lot of questions around that. In fact, you just wrote the report on the Gen AI, too much spend, too little benefit. I think that is really where investors are right now as compared with as recently as a month ago.
And the bar's got to be pretty high right now too, right? Because ultimately, even if the earnings have matched the performance or driven the performance, valuations are high. So does the valuation question concern you at all?
The valuation question is a concern. The overall index for the S&P 500 trades around 21 times forward earnings, which is high. It's around the 91st percentile versus history. So it's certainly high in a historic basis. On the other hand, the margins for U.S. corporates are extremely high, and the interest rate environment relative to history is actually relatively somewhat lower than average. In this environment, our models suggest that the market multiple is likely to be slightly lower than it is now, maybe closer to 20.5 times by the end of this year. So a slight multiple compression is part of our assumptions in our forecast for the S&P 500 at the end of this year.
And how much does the interest rate environment factor into that? Because, of course, the other big driver of markets and focus of markets this year has been the Fed. And, the fact that expectations for rate cuts have continued to be pushed later. How much impact does that have on how you think about the market?
We think about it in two ways. The first is from a fundamental valuation perspective. It's actually longer-term U.S. interest rates. Think about the Treasury yield, 10-year U.S. Treasury yields are around 4.25% right now. Real yields, real 10-year bond yields, adjusting for inflation, around 2%. That is a more important determinant of the multiple of the stock market. On the other hand, the Fed cutting rates, which is the expectation for both the market and our own economists, will have a particularly significant impact on smaller cap stocks, because smaller cap stocks, about 30% of their borrowings are in a floating rate form, and therefore lower interest rates at the short end of the yield curve will reduce their interest expense, leading some analysts to be raising their earnings estimates for these companies, and higher earnings, positive earnings revisions typically is associated with stock prices rising. So smaller cap companies will be the best, most proximate beneficiaries of an easing Fed policy. In contrast, the rest of the market, the broader market, is more linked valuation-wise to the longer end of the curve.
Understood. Okay, so if we put this all together, we have this tremendous performance in tech stocks, but there's a lot of concentration today. We have the cuts not coming as soon as we expected, but you've recently raised your forecast for the S&P 500. So walk us through what led you to make that forecast change.
Allison, there's basically two reasons why we've raised our forecast. Previously, it was 5,200. Currently, we expect the S&P 500 to close this year at around 5,600. That's a very modest 2% gain from where we are today. So slight increase in the opportunity set for returns in the market. There are two building blocks. One is valuation. The other would be earnings. The typical pattern of earnings revisions for consensus estimates for the analysts, and the market does price consensus rather than our forecast, the consensus expectations typically fall by 8%. Analyst estimates are cut by 8% over the investment horizon. The pattern this year has actually been no reduction in aggregate level of earnings. As I said earlier, you had a 38% increase in the expectations of earnings for these 5 leading AI beneficiary companies, and the rest of the market has seen a 5% decline. But as a result, we're not anticipating very much of a decline in the consensus expectations. That's sort of one aspect, a less than average negative revisions pattern. The second would be in our valuation models that the fair value of the market would be slightly higher than we had previously assumed, and now it's likely to be in the vicinity of 20.5 times. Previously, it had been closer to 19.5 times. So a slight increase in fair value for the multiple and a slightly smaller decline in consensus expectations.
So if I'm hearing you correctly, the market is more optimistic than you expected it to be or what the historical pattern has suggested it would be. But is the market too optimistic?
Is the market too optimistic? My response would be it's fairly valued, and the trajectory of the market going forward will pretty much be in line with the trajectory of earnings, and earnings are growing modestly. As we look into 2025, and portfolio managers are already focusing on next year's earnings, likely to be rising by around 6%. So our expectation is the trajectory of the market looking out, a year's time would be rising somewhat in that direction. And in fact, 12 months out, our forecast of 5,700 for the market is consistent with that trajectory of earnings. And so the market is fairly valued in present time. And as the equity earnings are higher over time, then you'll probably get a higher level of the market as well.
But within that 12 months, we have a U.S. election. And you've pointed out that this type of election uncertainty that we're facing can often be really challenging for stocks. So why are you looking through that potential volatility, or are you not? And that's sort of embedded.
I think about the election in a couple of ways. First, the general pattern historically is that equity prices decline coming into the election. Volatility increases because of uncertainty, and share prices decline slightly. Once the election is concluded, the uncertainty is resolved, And history shows that the equity market rallies pretty significantly. And so that would be a pattern as we think about sitting here today in late June, early July. You're looking at a situation where there's likely to be some volatility, downside risk in the early fall, and that's likely to be resolved and the equity market moves a little bit higher. That's the first issue. Second issue is, from a policy perspective, tariffs has really been the biggest area of discussion with portfolio managers most recently. And what we find is our portfolio of companies, which is primarily domestically facing in terms of its revenue sources, have outperformed a comparable portfolio that's more internationally exposed. And the intuition behind that is investors are concerned effectively on the retaliatory tariffs that may take place, and therefore those companies that are dependent on non-U.S. revenues would be more at risk. And that has, in fact, been the case both this year, as the probability of Trump presidency has increased, that two baskets of stocks, domestic outperformed international by around 5 percentage points already. And that, in fact, was the pattern that we saw in previous years with the idea of rise in tariffs when the non-U.S. exposed companies tended to lag.
As a previous forecaster, I think it's always difficult to forecast it's going to go down and then it's going to go up. But that's essentially what the historical pattern has shown around elections.
If you wanted to think about this from the options market, the option market assigns a premium to the options contract in October, which is the forward 1 month volatility and covers the period of time around the 5th of November, which is the election date. However, the timing of when the election is ultimately decided may take longer, and as a consequence, actually the contract in November may be the more interesting opportunity for institutional investors to think about, because that trades at a discount, and the idea of mandatory recounts, voluntary recounts, et cetera, may mean a delayed resolution of when the election is finally determined.
And that probably would be perceived pretty negatively, I would assume, by markets.
The uncertainty is likely to be high around this election in particular, given how close it was in 2016 and 2020, and the idea of so many states are quite close, and many states have the requirement that if two candidates are within half a percentage point of one another, there's mandatory recounts. In other cases, you have states where there's voluntary recounts allowed, and so this is likely to be potential for an extended period of time to resolve the election.
Yeah, so potentially fun times ahead. If we think beyond the election risk, what other risks do you focus on that present upside risk or downside risk to your forecast?
The central risk in the market is around the AI topic. And the reason for that is that, as we said at the very beginning, the return to the stock market this year in the United States has been driven to a very significant degree by relatively few number of stocks, all of which are associated with this theme. And to the extent that investors become more cautious on the economic or financial benefits for companies who are making these investments, that would put the valuations of those particular companies at risk. They do trade at a meaningful premium. That certainly was the experience in the dot-com boom in the late 2000s. Very, very strong revenue expectations were ultimately not met. Companies still delivered strong revenue, just not elevated levels that was anticipated. And as a result, multiples compressed a lot. So that is a number one risk that's both most proximate and most concerning as an analyst, as a strategist. This is obviously something we focus on a lot. And when we speak to portfolio managers, we speak to corporates, the questions of how timing and the magnitude of what benefits may inure to corporations as a result of all this AI investing is becoming less certain.
Let me throw one more risk into the hat, if I may, which is positioning. Given the outperformance of U.S. stocks and of this handful of U.S. stocks that have driven this outperformance, are investors already chock full of these stocks? Are there any more buyers out there?
There are two sources of demand for shares in the United States right now. The first is corporate repurchases. That is the largest source of demand for shares. Our expectation is that there'll be around $934 billion of demand by companies to repurchase their own shares. That's the biggest source. The second source is an interesting one, which is that actively managed equity mutual funds, their portfolios are underweight in the largest technology stocks. And as there has been a secular shift of money going from active to passive products, whether that's an index-related product or an ETF, as money goes from active to passive, there is actually a net buying of these shares. And so portfolio managers at an active basis are perhaps 700 basis points underweight these largest companies. That is a source of net demand. And that's an interesting aspect. That's, again, in the mutual fund community. And if you look in the hedge funds themselves are very significantly overweight. Their largest positions, in fact, are the largest companies in the market.
And why are the actively managed mutual funds underweight?
Part of the reason for their being underweight has to do with government regulations and the SEC guidelines on what determines what is allowable for a diversified equity mutual fund requires it to be diversified. And the concentration of the indexes right now, in many cases, puts the active manager in a position that he or she has to be diversifying outside of the largest companies simply because they would cause a mutual fund to be in violation of the requirements to be a diversified fund. And so therefore they are choosing to generate alpha and trying to generate excess returns through other companies. But again, the idea of these largest companies showing terrific sales growth, high margins, share prices are rising, has made this more and more challenging as the year has gone along.
And provided more incentive, therefore, to move from the actively managed mutual funds to the passive funds, which are exposed to these names.
Correct.
Thanks so much for joining me, David. Great to have you.
Thanks, Allison.
This episode of Goldman Sachs Exchanges was recorded on Wednesday, June 26, 2024. I'm your host, Allison Nathan. If you enjoyed this show, we hope you subscribe on your platform of choice and tune in next week for another episode. If you want more insights from Goldman Sachs, make sure to visit gs.com and sign up for Briefings, a weekly newsletter about trends shaping markets, industries, and the global economy. Thanks for listening. The opinions and views expressed in this program may not necessarily reflect the institutional views of Goldman Sachs or its affiliates. This program should not be copied, distributed, published, or reproduced in whole or in part, or disclosed by any recipient to any other person without the express written consent of Goldman Sachs. Each name of a third-party organization mentioned in this program is the property of the company to which it relates, is used here strictly for informational and identification purposes only, and is not used to imply any ownership or license rights between any such company and Goldman Sachs. The content of this program does not constitute a recommendation from any Goldman Sachs entity to the recipient and is provided for informational purposes only. Goldman Sachs is not providing any financial, economic, legal, investment, accounting, or tax advice through this program or to its recipient. Certain information contained in this program constitutes forward-looking statements, and there is no guarantee that these results will be achieved. Goldman Sachs has no obligation to provide updates or changes to the information in this program. Past performance does not guarantee future results, which may vary. Neither Goldman Sachs nor any of its affiliates makes any representation or warranty, express or implied, as to the accuracy or completeness of the statements or any information contained in this program, and any liability therefore, including in respect of direct, indirect, or consequential loss or damage, is expressly disclaimed.